What's going on, YB? How you feeling, brother?
Doing great, brother. How you doing?
I'm fantabulous. Beautiful people, welcome again back to A Better Life for You. And as always, Yaber and I are here to talk to you about interesting topics that we think you all can use on a daily basis. But I'm gonna get right into it, Yaber, because the other day we were having a conversation and you started talking about life insurance.
Hmm.
And so you schooled me on so much that I think it's important that we share with everybody the information that you shared with me because I was completely blown away. And the reason I was blown away, Yaba, is because now you have to understand for 28 years I worked in retirement,
Right.
right? I worked in the financial services industry, but I worked on the retirement side. So I was a huge advocate for 401ks, 403bs, IRAs, Roth IRAs, etc., and really didn't pay attention to life insurance. And for me, I thought of life insurance as, if I put money into this thing for 30 years, after 30 years, I lose all the money.
Right.
And I was completely wrong. So I'm going to just kick this over to you, Yaba. Please share with the good people what you shared with me.
Not a problem, Nate. And you were right about focusing on retirement. That's not a bad thing. Actually part of the puzzle is your retirement. Unfortunately, for people, especially in underserved communities, life insurance is labeled one or two ways. Like you said, as a waste of money, because
Right?
or like a scam. And I always tell people there are reasons why things happen. So there's always some truth to some, even some fabrications. There's usually a little bit of truth in there. Unfortunately for our community, because they're not educated about insurance, we have been disappointed by the results, right? So we've all heard about auntie or grandma who paid all this money into insurance policies, and when she died, the money wasn't there, right?
Right.
We've
Right.
heard all the stories about um, life insurance being like an investment, and it turned out they took my money, right? So let me try to level set things a little bit. There are two types of insurance. One is term and one is permanent. And you really want to hear this because I know life insurance isn't a sexy discussion usually. And I'm not saying this is actually going to be a sexy discussion. What I am saying though is you're going to learn something that you need to know to make sure your life goes a certain way. Again, making your life better, right?
Yeah.
So
Yeah.
first thing, term insurance is really, you can use another adjective and call it catastrophe insurance, right? Term insurance has a specific goal is to cover the income you're generating right now for your family. So the example I used to give when I was doing presentations, and just know my background, I was 10 years into financial planning. I took my Series 6 and 63. I helped thousands of clients with their financial planning, insurance, and things like that. So one example we used to give was if you had a machine in the backyard that produced $75,000 a year, every single year consistently, would you insure that machine to make sure you got your $75,000 every single year? And everybody said,
Right.
yeah, no problem. Well, if you're producing $75,000 a year and something happens to you, are you insured? Mhm.
Right. Right.
Because
Right.
that's the key component because most households are built on two incomes or one income. But if you're two incomes and you lose one, that lifestyle cannot be maintained off one income.
Very
That's where
true.
the term insurance is supposed to come in, right? So if you get $750,000 worth of insurance, that's 10 years of $75,000 coming into your family. So now the kids have lost you, but they haven't lost their lifestyle, if that makes sense.
Yes.
And so
Absolutely.
the other part is say you're not in a two-person household and it's a single parent, you want to have that money because if you have multiple children, it becomes difficult to keep those kids together because of the financial burden that comes. I mean, people got love all day, but they don't have money all day long.
Right.
And so you don't want to have a double catastrophe. The kids lose you and they lose their siblings. So it makes it much easier if you say, "Hey, I got these two kids, and I got $70,000 goes along with them, to help take care of them." It's
Right.
easier
Right.
versus here are these two kids, and like, wow, you might want to, but you barely making it yourself. So that's the first thing. So now the permanent insurance. Let me say this first: be careful about people who are telling you that insurance is a magic ticket. It's not. It's
Okay.
a tool, but it's a very effective tool. And what I mean by that is permanent insurance has several different things that it does. One, in the actual name permanent insurance, it's going to be there until you die. Also, the premiums never change. So you start paying $100 a month, it will all of a sudden go up to $200 a month, 10 years from now. It is
Gotcha.
set price. The key part that people miss, though, it can be part of your retirement. And wait a minute, how's insurance part of my retirement? Because there's a mechanism designed in these insurance policies where the money you put into that policy, the portion that pays for the insurance goes to insurance. The other piece goes to the other part of the insurance policy, which sometimes it acts like a bond, and sometimes it's put into a mutual fund. And it grows and it grows and it grows. 20, 30 years later, sometimes there's 50, 75,000, 100,000, 200,000. I've seen policies with $500,000 in them at age 65.
Wow.
And what people do is people use them as supplemental income for retirement. Well, how does that work? So I'm going to give an example about my mom. So my mom retired as a teacher. She had a pension, and she was getting between $75,000 and $80,000 a year from her pension, right? So she thought she was going to be good. And she was for the most part until the tax code changed. When the tax code changed, her monthly income changed because now she's paying a different set of taxes than she was before. That's because all her money was in one bucket. Now, Nate mentioned Roth IRAs earlier. That's another way to get outside the tax system too. Roth 401ks are now available too.
Right.
But usually that money, while great, I suggest you do those because the reason why people deferred taxes to begin with was taxes were high and they wanted to defer it for a time when it was lower.
Right. So because the idea behind that is when you retire, you're in the low income tax bracket, so you're getting the money back at a lower bracket, right?
Yes.
It's tax deferred.
But most times people aren't in that much lower tax bracket because the bracket is so big, right? It's not like, if you make, 100,000, you're in one bracket, you make 80,000, you're different bracket. And really that bracket goes from like 50,000 to like 100. So it's like, it's not really
wide range.
It's a wide range. And also the likelihood of it going down and the tax bracket being more favorable to you is also not actually true because the tax bracket has changed and it affects the middle class first. And so a lot of times we're always going to be paying the majority of the tax bracket because that's who fits the bill for the tax system for the most part. But the point I'm trying to get to is this. So I get perfect. So my mom is getting 75,000. If my mom had done a permanent life insurance where she could take 50,000 from that one year and only 25,000 from another, her taxable income would be $25,000 because the money coming from the insurance would be considered a loan and it would be non-taxable. And so it's a way to give you leverage to kind of create your own bracket that you want to be for your taxes. Now, there's a lot more to it than what I'm saying right now. And I'm not trying to make it, trust me, I have no dog in the fight. I no longer sell insurance. So I'm not trying to.
Right. Yeah, neither do I. I mean,
right. So there's no dog in the fight for either one of us. But I do understand that my clients who have done this have written me thank you notes because if you set up correctly, this can be kind of like your own bank. And there are policies there. You got a 5% loan that work like bonds, and you can take that money out. And then the dividend actually pays your interest for that loan. So if you don't have a loan for that, you really don't have a loan because the policy has an interest, a dividend part to that loan that will pay the interest for you. Then there's loans that are as low as 1%, as low as 0%. And there's no payback terms. And like, how can there be no payback terms? Because the death benefit covers the loan. So if something happened to you, they're going to get their money back eventually through either you pay it back to them or you take out the death benefit. But if you take out a $50,000 loan and you have $1 million policy, I mean, so it's like it doesn't really make them a difference. But it gives you so much flexibility to be able to put 150, 175 away every single month. And before you know it, after you pay the insurance in our policy, that money goes into the mutual fund. It goes into like a bond, like you also get the dividend. And before you know, you have $5 grand, you have 10 grand, you have 20 grand, you have 30 grand. So now if you want to go purchase a home, you don't have to save up for your down payment. You can go to your policy and take it out and not be stressed about it. Or if you need a new roof and it costs $10,000, you don't have to be stressed out about putting your credit card and trying to find a way to pay it back at 15% interest or 22% interest or 29% interest now on some of these cards. It's now you can just go to your policy and get a 1% loan or 0% loan or a 5% loan. So it's one of those things where it serves multiple purposes. They have to be structured correctly. I have to say that again, because there are some bad players out here or people who are not educated enough on how to structure these insurance policies in a way where it does multiple things.
Right.
But when I tell you, it's one of the best kept secrets I've ever seen in the financial industry, especially
Wow.
from the Black community. It is truly one of those things.
Yeah. I mean, yeah, but we've known each other over 30 years, right?
Right.
I was in the financial services industry. Now, I don't even know if you would approach me with that conversation we had the other day about this. I would have been open to it then, but I wish we would have had that conversation then because, while I was contributing all my money into retirement accounts, I could have just taken a piece of that and put it into a life insurance policy, right? And again, another money tool that, like you say, our community doesn't take advantage of.
Yeah, it's one of those things where I think I don't really blame Black people because I always tell I said to my clients, I said, there's no class you can take, there's no online thing you can read because the online stuff conflicts, right? So you read one thing and then the other thing says the exact opposite, and then you get confused about what to do, so you end up guessing, right?
Right.
So my job is always to break down the pros and cons of everything because everything has pros and cons. Nothing's perfect, right?
Right.
So one of the drawbacks of insurance is the insurance cost, right? So you often hear the argument, well, my investment does better. It's supposed to do better. If
Right.
your investment is doing the same as an insurance policy, you're in a bad investment.
Right. Right.
So that's not the design of it. The design is to handle multiple things with one item. So that permanent life insurance allows you to have a permanent death benefit. How many times have people actually died and there was no money for a funeral?
Right.
A lot,
Right.
especially in our communities. You got to do the GoFundMe or try to raise money between the family, that kind of thing. So it takes away that issue because, again, it's permanent life insurance. The second thing it does now, it creates this pool of money that grows outside of the tax system. So if you want to create your own tax bracket, like I explained earlier, now you can then play around. I'm going to take 30,000 out this year to supplement my income, and only take I guess 45,000 from my taxable income. Or do I want to be in a lower tax bracket? Do I want to take 50,000 from there and only take 25? So it allows you to manipulate the tax system a little bit better for yourself. And then that's our retirement. And then move forward as you're younger, you can then use that for different emergencies or to purchase property or to invest in your business or to different things. But it is a tool to be used consistently over time that you really can't find anywhere else. And the last example I give is I try to compare it this way. So whenever we have large sums of money, there's really three places that we go for that. One, we go to, if you own a home, you go to your equity, right? You'll go get an equity loan,
Right.
build a deck, or do whatever you want to do, pay for college, blah, blah, blah. If not, you go to your retirement fund, right? Where you're going to pay 40% to the government.
You're gonna
You're
pay a
like
penalty.
40%? Yes, it's 40% because
Yep.
it's 10% penalty because you're not of age yet. Then there's federal taxes, which usually at least 25%. So we are at 35 already.
Most people
And
in
then
that.
if you do a state tax, that's 5%. So that's 40 you pay on. So we take out 10,000. You're not taking out 10,000. You're taking out 6 because Uncle
Right.
Sam got 4,000.
Right.
So that's that part of it. So when you do it that way, there's always going to be taxes or loan interest. Because you took a loan out too, the loan interest is structured, right? So you have to pay back a certain amount every single month. You can't miss more than 2 payments because you go in default. Or if you leave the job, borrowing from your retirement fund, it all comes due, right?
Right. Right.
So
Yeah.
that's the two things we get made. And here's where insurance differs. If you go to your insurance and there's 40,000 in there, you say I need 10,000 to take care of my roof, or I want to purchase, start some of my business. They say it'll be in your account in 3 days. You're like, that's it. That's it.
No questions asked.
No questions asked. And what happens is there is a loan interest attached to it. So do you have a monthly payment plan? No, no monthly payment plan. Well, how is it a loan then? Well, that's the term they use to call it that. I don't think they should use it because to me it doesn't actually
Right.
describe what
Right.
it is. But that's what they use to call it, and technically it is a loan. So the interest does accumulate in it, but at a very small rate, right? So you can decide to pay back when you want. I always tell my clients when they do borrow from it, make a payment plan back because you want to be able to reuse this over and over again,
Right.
right? So my client would take out 10,000, pay it back. Take out another 20,000, pay it back. Because that became like their bank for them. So they start
Wow.
bypassing getting loans from banks. They start using their own bank. So
So in essence, depending on the type of policy that you get, you can literally have your own bank.
yes, literally.
Wow.
And that's the part that we have to get better at communicating. And if you guys want, you guys can comment in the comment section. I actually still have friends who are still in the field. They can come on and break down different policies and all that kind of thing. If you want to do it that way. And they also, I'm sure they'll take appointments, I'm sure. But it is something that we have to do a better job at communicating to our community. One, because when somebody dies, should not put other people in debt. That's the
Right.
first thing.
Right.
So we have a mechanism which, and permanent insurance policy, you want to get them as early as possible because the older you get, the more they cost. And I'm gonna tell you a couple secrets about the insurance policy, the insurance industry. It is so much cheaper to get permanent insurance policies when you're younger because you're the healthiest, right? So as you get older and use that magic number is 50. Once you cross 50, the prices start really jumping for permanent policy, so it becomes a real problem. So a lot of times people have term insurance for the younger years, and then once they
Mm,
realize that that's going to run out, I now want to get permanent insurance, but now they're 45, 50, 55, and now it costs too much because nobody had a conversation with them at 23, 24, 25 to say you should also be looking at possibly getting permanent insurance
right.
or get a term policy that can be converted into a permanent
I
policy.
was just getting ready to ask you that. Can you convert it?
Yes, you
Can you
can.
convert
So,
it?
and most of them have a conversion piece to it. Um, I think most of them have a 10-year conversion window. I think it can be extended longer than that, depending on what policies you get in term policies. But yeah, a lot of my clients would get permanent policies, really small ones, so they can start building that cash inside of it. But they also have term, and then we decide when they want to convert at what times. If they got a promotion or they got a different, took a different job, they got paid more, then we would convert more of it over.
Interesting. Wow.
Yeah. Yep. So that's pretty much it. Hopefully that wasn't too boring or too confusing.
Yeah. Um, I'm glad we had that conversation, man. I have a nephew that just became a dentist, and these are some of the things that I want to share with him. Like, let's
And
get
if you want to
started.
talk to him, I can talk to him too because
Yeah,
I still
absolutely.
I still enjoyed. That's the only part I do miss about the field. I enjoy educating our community on these things because, as I said to you, I don't know if I said it here or I said it to you earlier. There is no class for us to really get this stuff from, so we shouldn't feel ashamed that we don't know. And I
Of
never
course.
wanted people to feel bad about not knowing. I was just happy I could tell them, teach them about this stuff. Because when I joined New York Life, the company I was with was New York Life, and they taught us pretty much everything from A to Z, from insurance to investments, that kind of stuff. So when I got a chance to talk to my community, I was excited. I was like, man, check this out. We can do this. We can add this. You know about this? So it's like there's a whole thing that has to do with your retirement plan, right? Because people, when they go to their retirement, we might do another video on that one. Because what I would see people do is take a job, HR will handle a bunch of papers and say, here's your retirement plan, pick something. And people like, what do I pick? HR like, I don't know. So the people then go to their coworkers, what did you pick? They say, well, I picked these things. I'll do what you did. And that's their retirement plan.